Let's bring in Onsemi CEO Hassane El-Khoury. Hassane, thank you for joining us. So is the downbeat guidance related to the auto strike in any way?
Thank you for having me. But no, the down view that we've had for the Q4 guidance is not really related to the UAW. Although we don't see the impact directly from the UAW, obviously time will tell, because I think you mentioned earlier the design cycle, the latency of it, but there's no direct impact that we've seen from the UAW. The commentary that we've had is more of a broader view of the automotive.
So talk us through that broader view and why it came as such a surprise to Wall Street.
Yeah, so we've always talked about, small pockets of inventory that everybody has really talked about from a periphery. Couple that with high interest rates that are impacting now the end demand, it's going to take longer to bleed that inventory. We thought the bleeding of the inventory will happen at a shortened phase, but with the demand slowing, given the high interest rates, we see that inventory lasting longer, and we're taking a very cautious approach of not making the problem worse by shipping above end demand. So we're taking what we can't control, which is what we ship into the market, until we see a more favorable inventory and really demand environment in order for us to pick back up.
Hassane, it's coming on the same day where Panasonic cuts their domestic battery production forecast. They cite weaker demand of some Tesla models like the S and the X. To what degree is this an EV story?
So EV story, obviously, there is some impact from EV. We've had that in our Q4 guide, specifically on the silicon carbide outlook. But one thing I do want to touch on, the reduction or the outlook for silicon carbide doesn't mean that EVs are going down or silicon carbide revenue for us specifically is going down. It's actually the opposite. Even in a weaker guide in Q4, silicon carbide is still going up, which is strength in EV. And we highlighted on the call in 2024, silicon carbide is going to still grow about 2x the EV market, which is also growing, depending on the reports you look at, between 30 and 40%. So for us, silicon carbide is going to be 2x that market. So strength in EV is still there. We're not managing our EV exposure or our EV-related investment on a quarter-to-quarter basis. We look at it from a long-term view, and the long term is still very bullish because it is a mega trend, and e-mobility is the future of mobility.
Yeah, that's sort of what I was going to ask, is that your case has been that this is a secular growth story when it comes to EVs and the industries you're in, and that you have a market-leading position in the silicon carbide. So how do we square that with some of the now cyclical concerns and the tougher macroeconomic environment you point to today?
Yeah, the growth is still there. And again, it depends what you believe, or you believed the growth for EV was going to be versus what it is now, given the softer demand. But that doesn't mean that demand is going down. That's the distinction I want to really make sure everybody understands, is EV is going to increase. The number of percent of EVs sold of a total percent of vehicles made is going to increase again next year. So the trend and the mega trend that we talk about, that we're investing in and the industry is investing in, remains intact. It may be at a different rate in the short term than we would like to see, but nevertheless, it is growth, and we are still investing in that growth, and we're going to see the result of that investment with us going 2x the silicon carbide, 2x the EV ramp.